One of the monthly dividend ETFs on this list pays $2,759 a month from a $100,000 investment, and I'm going to rank it dead last. Today, I'm breaking down the 8 best monthly dividend ETFs for 2026, but I'm not ranking them by yield. I'm ranking them by the one number that tells you whether a fund is building real income or slowly giving your own money back to you. And here's the part that might sting. The ETF with the smallest paycheck on this list, it had the best total return of the entire group by a mile. If you're in your late 40s, you've probably had that moment. You see a high-yield ETF advertising 14%, 20%, even 33% yields, and you think, that's how I build the income I need before retirement. But most people never check the one number that separates the funds that actually work from the ones that just look good on paper. That's exactly what this video is for. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. The one test that matters. Here's something most people don't realize about monthly dividend ETFs. The yield printed on the front of a fund, that's just a math number. It tells you the payout rate. It does not tell you if the fund is healthy. Here's the test. Takes 10 seconds. Take the fund's 1-year total return, subtract the distribution rate. If total return is higher, the fund grew. Your principal went up while it paid you. If total return is lower, the fund is shrinking. It's using your own money to keep those monthly checks coming. Let me show you what that looks like with real numbers. EGGY, one of the ETFs on this list, has a distribution rate around 37 to 41%. Sounds like a dream, but the share price dropped from about $50 at launch to roughly $36.50. That's a 27% decline. Now compare that to GPIQ. Goldman Sachs pays only 10.5%, but its 1-year total return hit 32.32%. GPIQ's share price went up. EGGY's share price went down. Same type of fund, opposite outcomes. Here's the myth. A higher yield means a better fund. Here's the truth. Yield is a rate. Total return is reality. And the gap between those two numbers tells you whether a fund is building your wealth or quietly borrowing from it. Now, before I show you how all 8 funds stack up, take a guess. Which fund had the better total return last year? The one paying 33% or the one paying 10.5%? Hold that thought. The 3 best covered call ETFs for core income. Most channels run these numbers on $100,000, but let's be real, if you've got $250,000 to $400,000 saved, you're not putting all of it into income ETFs. A smarter setup puts around $75,000 into your income sleeve, so that's the number I'll use. 3 funds pass the yield trap test convincingly. They have the AUM, the track record, and the NAV stability to qualify as core holdings. Number 1 on my list, GPIQ, Goldman Sachs Nasdaq 100 Premium Income. This is the surprise winner. Distribution rate 10.5%, 1-year total return 32.32%. That's a growth gap of almost 22%. Actually, let me be precise, it's 21.82%. The share price didn't just hold, it grew big time. Here's what makes Goldman different. They use a flexible call writing strategy. When markets are calm and stocks are running, they only cover about 25% of the portfolio. You keep most of the upside. When volatility spikes, they ramp coverage up to 75%, harvesting bigger option premiums. They're collecting more when it's richest and stepping aside when stocks want to run. Expense ratio 0.29% net. That's the lowest on this entire list. And yes, some channels are saying Goldman plans to raise it to 0.35. That's actually not what's happening. 0.35 is the gross ratio. A contractual fee waiver brings the net down to 0.29, and that waiver is still in place today. AUM, over $5 billion. From $75,000 invested, you're looking at about $656 a month. Number 2, SPYI, NEOS S&P 500 High Income. Distribution rate about 12%. Total return over the past year, roughly 17 to 19%. Growth gap, positive. NAV has held steady since the 2022 launch. AUM, over $10 billion. SPYI uses S&P 500 index options that qualify for something called Section 1256 tax treatment. Here's what that means in plain English. 60% of the gains get taxed at the long-term capital gains rate, 40% at the short-term rate, no matter how long you hold the fund. That's a real edge in a taxable brokerage account. About 94% of SPYI's recent distributions were classified as return of capital, but here's the key. That's the good kind of ROC. It's a tax classification from those 1256 contracts. It's not the fund eating itself to pay you. The proof is in the NAV. If the share price is stable, the ROC is healthy. From $75,000, about $750 a month. This is the workhorse. Number 3, QQQI, NEOS NASDAQ 100 High Income. Same options engine as SPYI, but built on the NASDAQ 100. Distribution rate, about 14.5%. 1-year total return, around 26%. Growth gap, positive. AUM, over $13 billion. Higher yield, higher growth potential, more volatility. From $75,000, about $906 a month. Quick question before we move on. If you could only pick one of these 3 as your core income ETF, which are you going with? GPIQ for the growth, SPYI for the stability, or QQQI for the bigger paycheck? Drop your pick in the comments. I read every single one. So those are your core options. Solid, proven, NAV holding up. But some of you want more than just income. You want growth alongside it. The next 3 funds try to deliver both, and one of them returned over 50% in a single year. High-yield ETFs that also grow. 3 funds deliver income and strong total returns, but each carries a trade-off that keeps them in satellite territory. QDVO, Amplify Growth and Income. Distribution rate, 10.69%. 1-year total return, 20.6%. Growth gap, about 10%. Solid. This fund writes tactical covered calls on individual growth stocks. The top holdings are names you know: NVIDIA, Apple, Alphabet, Amazon, Microsoft. It only covers part of the portfolio, so you capture more upside than a fully covered fund. Expense ratio, 0.56%. From $75,000, about $668 a month. The trade-off? It launched August 2024. Strong numbers so far, but less than 2 full years of history. IWMI, NEOS Russell 2000 High Income. Distribution rate, about 14.4%. 1-year total return, roughly 35%. Growth gap, over 20%. Small caps had a phenomenal year. Now, some channels are calling IWMI a core holding after this year. I think that's a mistake, and here's why. One outstanding year in small caps doesn't change the underlying math. The Russell 2000 can drop 30% in a bad year, while the S&P 500 drops 20%. Small cap earnings are less predictable. Balance sheets are weaker. For someone in their late 40s, someone who can't afford to watch their income sleeve get cut in half right before retirement, that's a risk you size for, not a risk you build around. 10 to 15% of your income allocation, maybe. Not 40, not 30. From $75,000, about $900 a month. EGGQ, Nest Yield Visionary. This is the outlier, lowest yield on the entire list at about 6.85%, but the share price grew from about $50 at launch to $62. 1-year total return, roughly 53%. The growth gap is the biggest here by a wide margin. But let's be honest, this is really a growth fund that happens to pay a small distribution, not an income fund. The portfolio is concentrated in about 25 tech and innovation stocks. AUM is under $100 million, which means wider bid-ask spreads. Use limit orders if you buy this one. From $75,000, about $428 a month. All right, 6 funds down. Everyone passed the yield trap test. But there are 2 more on this list, and this is where it gets uncomfortable, because these are the 2 funds paying the biggest monthly checks on paper, and the math tells a completely different story. The yield trap in action. EGGS and EGGY, both from Nest Yield, both launched December 2024, both hold concentrated portfolios of just 10 to 25 stocks, and both show the textbook yield trap pattern. Let's start with EGGY, the fund from the thumbnail, the one paying $2,759 a month. Distribution rate about 37 to 41%. At the current rate, from $75,000 invested, you'd collect roughly $2,300 to $2,500 a month. That sounds incredible, but here's the number that changes everything. EGGY's share price dropped from $50 at launch to $36.56. That's a 27% decline in about 18 months. The 52-week low hit $29.15. At its worst, this fund lost over 40% of its value. Think about what that actually means. Say you put $75,000 into EGGY at launch. Your shares would now be worth roughly $55,000. You collected big monthly checks along the way, but that's, well, let me say it plainly. A chunk of those checks wasn't real income. It was your own money being handed back to you, and the fund called it a distribution. That's the yield trap. That's why this fund ranks dead last. EGGS tells a similar story. Distribution rate started around 21%. It's since been cut to roughly 15 to 17%. Share price dropped from $39 to $36. AUM under 60 million. Since inception total return through early 2026, only about 6.9%. Now look, I'm not saying these funds will never work. They're less than 2 years old. Maybe Nest Yield figures out how to sustain those payouts without the NAV erosion. But right now, under 150 million in assets each, share price down 27%, fewer than 2 years of data, I can't call either one a core holding. Not for someone in their late 40s, not with 15 years until retirement, not when every dollar of principal matters. If someone you know loaded up on EGGY because of that headline yield, share this video with them right now. They need to see the NAV chart before they put more money in. So now you know which funds pass and which ones don't, but knowing the ranking isn't enough. The real question is, how do you actually build this into a portfolio? Building your income sleeve. Monthly income ETFs are a powerful tool, but they're not your entire portfolio. Smart investors in their late 40s cap them at roughly 20 to 40% of your equity allocation. Here's how I'd think about it. Start with your core, GPIQ, SPYI, or QQQI. 60% of your income allocation goes here. These are the funds with stable NAVs, positive growth gaps, and AUM measured in billions. Next, add 1 or 2 hybrids, QDVO for growth first income, IWMI for small cap diversification. That's about 30%. Keep IWMI smaller than QDVO. Small caps swing harder. If you want a speculative satellite, EGGQ's growth profile makes more sense than the Nest Yield high yielders, 10%. Quick example, say you've set aside $75,000 for income, $45,000 split between GPIQ and SPYI, $22,000 between QDVO and IWMI, $8,000 into EGGQ for the growth kicker. That setup gives you roughly $1,000 to $1,200 a month in income with principal that's stable or growing. Not the flashiest number, but real, sustainable, still paying you in 15 years.
Number 1. GPIQ. Best risk-adjusted return, lowest fees, growing NAV. Number 2, SPYI, the workhorse, stable NAV, massive AUM. Number 3, QQQI, NASDAQ core income, higher yield, solid growth gap. Number 4, QDVO, growth first income, strong numbers, young track record. Number 5, IWMI, the diversifier, outstanding year, size it carefully. Number 6, EGGQ, growth satellite with a small income kicker. Number 7, EGGS, caution, distribution cut, NAV declining. Number 8, EGGY, yield trap, highest payout, worst principal protection. Don't chase the biggest check this month. Build the income stream that's still paying 15 years from now. Which of these 8 are you holding right now? And after seeing the NAV numbers, are you rethinking any of them? Drop it in the comments. I read every single one. If someone you know is chasing high yields without checking the NAV, send them this video. It could save them real money. Tell me, are you building your income sleeve around one core fund, or do you split it across 2 or 3? I want to know your setup. If you're building income from your investments and want to stay ahead of changes like this, subscribe to this channel. We break down the numbers every single week.